This is Trepp with a special guest podcast. I'm Haley Keene with Trepp, a data, modeling, and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. Today, we are joined by Twitter CRE sensation and real estate investor StripMallGuy. StripMallGuy has quickly ascended to become one of the most followed real estate personalities on Twitter. He has eclipsed 34,000 posts and amassed more than 200,000 followers. The success of his account has helped create an influx of anonymous accounts on the platform, especially in CRE, fueled by the retweet community. StripMallGuy has been investing in niche strip mall retail properties since 2006 and has allocated more than $100 million within that property sector. He now calls New York home after spending a large portion of his career in California. StripMallGuy, welcome, and thank you for coming on today's podcast. We're so excited to have you.
Thank you guys so much. Pleasure to be here. Fired up. Appreciate it a lot.
Awesome. So we'll jump right in. We've been reading your tweets, obviously, for years, but then also some of your interviews and profiles. And we saw one in The Real Deal and other publications. And you talked about how you got started by leasing small retail spaces to single location mom and pop tenants. It seems like quite the transition from small-time tenant rep to full-time investor and now an anonymous online influencer. So tell us about that.
Yeah, it's been a bit wild. A lot of it's been unexpected, to say the least. But yeah, I started doing leasing for mom and pop, small, 2,000 square foot spaces and smaller. And really, that's where the revenue comes from in the strip mall world. And so without understanding that part of it, you really can't do much else, I think. Investing is really tough if you don't know how you're going to lease space and, get things rented and create income. And so I started meeting with mom and pop businesses when I was 22 years old, figuring out how they ticked, what made a site work for them versus not. And I started looking into those attributes, parking ratios, traffic patterns, signage, that sort of thing, which, until this day is the backbone of everything we do.
So I know we have a lot of questions about your story and your background and your Twitter expertise. So we'll get through those over the course of this podcast. Lonnie, why don't you dive into the meat of this podcast here?
Yeah, we're really excited to have StripMallGuy with us for this guest edition of the Trepwire podcast. And this came about really as a byproduct of our guest podcast with Bob Knackel. So I noticed that StripMallGuy had commented and liked a couple of our Bob Knackel posts. And so I, threw the Hail Mary out there and said, hey, we'd love to have you on the Trepp pod. And he said, let's do it. So here we are. So for maybe our listeners that are a little less familiar with the Twitter sphere or some of the social platforms, StripMallGuy, can you kind of walk us through just how you stumbled upon the StripMallGuy persona online? Maybe what characteristics of StripMallGuy, the online version, how they're similar or dissimilar to you in real life?
Sure. Yeah. It really did happen by accident. I was on an airplane in June of 2021 from New York to San Francisco, and I was killing time. And I would check Twitter out once in a while and kind of not agree with what I would read sometimes about real estate. It was just things out there that were inaccurate. And, every time I wanted to respond, I would think about what one of my investors might think, or an employee or a tenant. And so I just opened up the account at that moment. Real estate Bill and Bob were taken. I don't know how I came up with Trent. I still don't know. And so I opened up the account and just started sharing my thoughts, without thinking that it would lead to anything or anywhere, or that there'd be an audience. And so it was unfiltered, and I would just share, what I knew after 20 plus years in the business, and had no idea that there'd be this big audience out there for it, let alone that it would completely change my life after that. So Twitter is somewhere where the audience is much more massive than I think we can comprehend. There's a lurker effect. There are folks on Twitter that follow you for a while, and after a bit, they kind of get to know how you think about real estate, about life, about investing, and they really get to know you when you're tweeting often. And so, I didn't realize that, right, my message was scaling and reaching folks all around the world, which then leads to DMs, and then, it leads to your network growing kind of like crazy, really. And so I'm really, my way of giving back is really, telling people and promoting the message of, hey, it doesn't matter who you are, jump into social media. If you do it the right way, it doesn't matter what you're doing in the business world, it can really, really help you in ways that you never could have imagined.
Yeah, I think that's great and it resonates. I mean, we have a nice social media presence here, but I think you definitely get an authentic, non-filtered ability when you're anonymous and you can just post based on what you think the market is telling you versus trying to toe or maintain a line for investors or tenants. So it's really great for you because I think you've mastered kind of balancing that. We'll have some questions about that later on in the podcast. I guess for our listeners, what was it that drew you into the strip mall property sector? Was it something that you just happened into, like you said, when you're 22 years old, you took the first commercial real estate job you could get, or was there always an affinity to that asset class?
I knew nothing about real estate until I was 22 years old. I graduated from college and was looking for a job. It was 2002. The whole dot-com crash had just, happened while I was in college, and I just needed a job. And it was a friend of a friend kind of deal where I went and interviewed with a gentleman who focused on leasing of Class B and C strip centers, and he offered me a commission only job. Go ahead and here's a phone. Good luck to you. And I just kind of tried it out. I mean, it was completely by accident, really.
Yeah, I think that's a narrative that's pretty common in the commercial real estate space. I know in our Bob Knackel podcast, he talked about how he thought Coldwell Banker was an investment banking shop, and then he ended up, being one of the most prolific CRE brokers in the United States. And so it's interesting how that plays itself out. So in the market cycle that we're in right now, credit is certainly tightening. Cost of capital is significantly higher than what we've seen over the last 10 years. But for your sector, consumer spending has remained, pretty bullish throughout this. So even though there's been inflation and the Fed's done what it's done, it seems like the consumer has continued to spend, which I would think would have positive connotations for your business. So how have you guys adjusted to the tighter credit conditions being a negative and kind of hedging against that, but also tapping into that resilient consumer that you're relying upon for your tenants to be successful?
So, I mean, if you look at what happened after 2008, what drove a lot of the bargains in the strip mall world was vacancy, right? So a lot of folks, if their loan's coming up and they're refinancing at a higher rate, as long as their tenants are paying rent and they're there, sure, they won't make as much money, but they can hang on, right? So it's been resilient for sure. Job market is great. Very low vacancy. I think it's a 15-year low right now. And so the net effect on us, which, we're value add buyers, is there are less value add opportunities out there. And so we have to work much harder. Instead of speaking to 10 brokers a day, our team speaks to 40 brokers a day. A lot of eyeballs right now are coming into the strip mall world. I met with a public company COO last week, retail REIT, and, they were telling me, hey, all these folks are now, all this capital is coming into retail. And the fact that it's holding on so well in this climate is the reason. Yeah, I mean, look, for me, the more the merrier, right? I don't mind more people in the asset class. I mean, I get told a lot, oh, why are you out there tweeting your secrets, et cetera. I said, look, if I'm an expert in this field and the field becomes much more relevant and the market is bigger, why would that be a negative? It's much harder to find deals that make sense, right? Values are down substantially. Sellers are not willing to sell at 40% less than the prices were at 2 years ago. And so when you have tenants paying rent and low vacancy, why would they?
So let me jump in for a second. You answered one of my questions, which is the why of why you're doing it. You kind of have broadened your audience and have brought more people into this particular market. But let me talk about the other side of being such a prolific influencer and being so visible. You have hundreds of thousands of followers. People must be DMing you all day. You have to balance that against the time of actively managing your portfolio, meeting with LPs. How do you find that? And do you ever risk burning out?
So I think that the very best use of my time, bar none, is finding a way for us to have greater deal flow. Deal flow is the backbone of the real estate world. I would say that capital raising, obviously, is very important. I've been doing it since 2006. The bottleneck is finding deals that make sense. Look, I was a broker in one market, and I know that if a buyer called me from a different market, say it was Texas, Miami, whatever it is, and I didn't care if he owned 100 properties, he or she would not be top of mind. You forget about them. You really have your local 2 or 3 people that you talk to regularly. What changed for me was about 5 months ago. There was a strip mall on the market in Pennsylvania, and I called the broker, who I don't know. And he was, reasonable. He said, hey, what's your email address? Let me send you over the package. There wasn't much to really talk about. And so I said, hey, by the way, are you on Twitter? And he said, oh, actually, yeah, I am. I said, okay, this is sort of a random question, but have you heard of StripMallGuy? And he's like, oh yeah, I'm a fan. I said, you know what, that's hilarious. That's my account. And he said, oh, well, I have 3 offers. Here's the price. Here's where you need to be. And I said, bingo. Have I just hacked top of mind nationally? Have I scaled top of mind where a broker that I don't know, I've never spoken to, will now be thinking of us as he comes across great deals? And to me, I didn't realize it until that point. And that was the game changer. Just last week, we closed on a property, I guess it was 2 weeks ago now, in the Midwest. It was a broker whose family goes to the animal hospital at the strip center. And he called me and said, hey, this is a great little center. It's for sale right now. You should look at it, right? That broker would never have thought of us in a million years before. And, we bought the deal. It was a great property. And, here's actual LP value created because of social media. So I get asked a lot, why do you spend time on this, right? Deal flow is the backbone. It's the holy grail of the business, because otherwise you're in the business of moving capital around, which, the larger funds, I get that, it's different. And I cold call brokers myself regularly. Like we have a team of 6, right? And so that's why I spend a lot of time on it, because if I can get that part right, if we can keep buying deals that make sense, the fundraising, our overhead, everything else will come into place. It'll all work out if we do that one thing right. And Twitter's helping me do that.
It's amazing how much that parallels exactly what Bob Knakal said, that he said being front of mind is so important. And before the internet, before he became a big Twitter presence, for him, it was all about the cold call and making sure that you were always front of mind. So just totally consistent with reaching a successful level is just completely always being in front of that client.
Exactly. And, I never thought it was possible to do within 1 or 2 markets. And, that was for us the challenge in scaling nationwide, is how do you get brokers to think of you for that valuable first call, right? And that wouldn't happen without this platform.
Yeah, it's really great to see. Not only does it allow you to talk through kind of your thesis and where you think you have competitive advantage from an LP perspective, but to your point, now the broker community has a central repository where they can come and know they have a captive buyer that can actually move on transactions. And for them, deal flow is how they get paid. So, to your point, deal flow on all sides of the equation is what makes this market work. And so let's jump back in a little bit to a couple of questions around just the way you've positioned yourself as a value add buyer. I know I've seen several of your tweets where you talk about having a deep understanding of some of the local market fundamentals, being very acutely aware of what current market rents are relative to maybe lagging contract rents, and knowing very quickly from a go, no-go perspective of, are you going to make a deal or not? Just give us some perspective on, how you guys view properties when you're looking at them from an acquisition value add perspective, and maybe some of the attributes that you think are most telling from an investor's point of view.
Sure. So about 97% of these properties are owned by local families, individuals, not funds, right? So you've got this back and forth between the mom and pop tenant business person, right, negotiating with the landlord who's doing this part-time. And so because of that, you really see a big disparity in between a market rent that a tenant can easily pay and should pay and what they're actually paying, because there's a huge fear of vacancy for the family whose 4 siblings split the $100,000 a month or whatever it is. Like, they'd rather have a lot less rent than go hire a broker, improve the building, cut a TI check, right? So we look for those day one inefficiencies where I say, you know what? This end cap tenant in 1,200 feet, like with a patio, should not be at $24 where everyone else is in town is at $40. And if they threaten to leave, I'll say, look, you and I both know it's $40 rent in this market. Here are the comps. Like, it's not a game. I don't need a penny above market rent. So that's number one, right? But also we look at things like, is this coffee shop on the going home side of the road or going to work side of the road? How's the parking ratio, the signage, right? Is there a burger restaurant who's really, really busy, who leases up next year, and because they're busy, there's never any parking, and that dentist, that salon, and that yoga studio is failing. And by not renewing that lease and saying, hey, love you, man, but you got to go somewhere else. Things like that we look at day one, and those exist in every single market in the US. It's not about any market. And, retail is retail. When Starbucks looks for real estate, right, it doesn't matter what the market is. It's how is this intersection, how are we going to do over here? It's not, well, it's this market versus that. It's, okay, well, here's this market. We can pay different rent here. And I think, as so much capital has been raised, right, in the world in the last 5 years, especially, and so much more data out there and competition, the idea of focusing on just one market, I think, no longer works. I think being agnostic, knowing your niche really, really well and applying it everywhere, I think is absolutely the future.
Yeah, I think it's really interesting. If you look at even some of the larger players in the market, they're all chasing yield. And as prices have skyrocketed over the last 5 years, that's forced them into secondary, tertiary markets, or maybe even down on the asset class because they couldn't get the yield that they needed to for their investors in the primary markets or the primary Class A space at the prices that they had to pay. So it's interesting, but they don't have, to your point, maybe some of the capabilities of moving quickly and understanding some of those nuances because they're used to playing in a much more entrenched marketplace. And so it's really interesting that you've been able to capitalize on that. And I have some friends that own an investment shop down in Houston that specialize in retail property. And, their investment thesis comes down to an acronym they've created. It's VAPS, visibility, access, parking, and signage. And so they can kind of go through their metric, score a property very quickly, and then feel like they have a go, no go, without a whole lot of additional due diligence outside of just knowing what the market rent is and those other factors. So let's talk a little bit. You had a post this weekend that I saw got some pretty good attention, but it was like, we don't 1031, we don't cost seg, we don't finance on the front end of the deal, we don't leverage properties above 55% LTV, and we don't care about the market. Right. Walk us through those topics. And if you could, maybe just tell us for each one a little bit of why you've chosen the position that you've chosen. Is it experience? Is it some additional nuance? Is it a free up flexibility? Like just how and why are you doing it that way?
So I am big on buying a property on the intrinsic value of that property. Okay, what is this real estate worth? Forget the yield. Okay, a yield has to do with what the rents are, and it's really based on tenant, right? So I was a kind of a nerdy guy in high school reading Ben Graham and intrinsic value, and I love Charlie Munger, and it's like buy the deal correctly based on great fundamentals. Okay, so if a property is terrible and it has bad parking and this and that, but it's worth $4 million and I can buy it for 2.2 or 2.5, it doesn't matter to me. It's a good buy per square foot, right? I bought a 4.5 cap deal about a bit over a year ago, but that's irrelevant because in the next 2 years the leases are up and they're at a third of the market. We already renewed that laundromat, not dry cleaner, from $12. I think we got $36 or $40, right? Great location. I'm not saying that 1031 is a trick. We'll get into that, or cost segregation, but I want to start with I'm looking for individual great deals, right? I mean, we've exited 28 times in a row since 2007, all profitably, right? And that starts with, well, what did you buy it for per square foot? My Twitter account, I'm proud of the fact that I'm putting out there a narrative of do real estate the right way, buy responsibly, right? Don't buy because you're in a 1031 and are a forced buyer. Everyone says, never be a forced seller. Well, what's a buyer in an exchange? You're a forced buyer. I love those buyers. They have to close and they pay top dollar. And oftentimes they overpay by more than their taxes would have been. Okay. Now look, over our 28 exits, our average hold time is 2.7 years. We get in there and we address the inefficiencies and we sell. All right. So if we 1031, the odds of us having the next great deal of the next 45 days are almost zero. For me, I'm not going to line it up perfectly. And what folks do is they overpay, and that 1031 is really, you're deferring the tax. It's not really going away unless you die, stepped up basis. That becomes an estate planning issue, right? And so for us, I believe in buying great deals, not using, sometimes folks use that exchange as like a trick and they overpay and they feel good about not paying taxes, but what have they really accomplished, right? And so there are obviously ways it works for a lot of people, and if you line it up correctly, and if you don't overpay, it could be great. And as far as cost seg, because we only hold these things for 2.5 years, by the time we get that study done and we pay for that, we're selling. And then obviously, as you guys know, any time you depreciate, it just gets paid back when you sell, if you sell at a profit, and we don't exchange. So it really doesn't work for us. So a lot of my count is based on buy right, look at fundamentals, and don't look for the tricks to kind of lead your way and lead your investment. So I think that's what it really was about.
Today's podcast is sponsored by our friends at the Henley Group, experts in CMBS and CRE CLO loan modifications and restructures. They've been trusted advisors to borrowers facing challenges with their CMBS loans for 15 years, obtaining an extraordinary success rate for their clients. So if you're having issues with a securitized loan, they are definitely the team to reach out to. We know Tammy and David Goldfisher well and have learned a lot from their perspectives here on the podcast. Happy 10-year anniversary to the Henley Group as Trepp clients.
So along the way, you've made a couple of remarks, one about the burger joint that takes up too much parking. You've also talked about the dry cleaners made of sides. I know from following you on Twitter that Chick-fil-A, dry cleaners, and for a reason I don't yet understand, karate operations are, not favorably regarded by you. So walk us through all three. I think I kind of get the Chick-fil-A thing.
Sure, I will. First, let me preface and say that, these co-tenancy issues come up in retail and really nowhere else. So like if someone wants to rent an apartment, if they have good credit, they can pay the rent. Here's a lease. There's a million other things to look at, which I think makes retail difficult. So Chick-fil-A, I love. The problem is if you have a strip center and here's your dentist, here's your hair salon, yoga studio, etc. And one day that owner says, oh, I'm going to create $5 million of value by bringing in a Chick-fil-A on the corner. Great. The center behind it is worth 10 million, your shop space, let's say. Now you've essentially destroyed that as a business place for your tenants, right? No one's going to the dentist if they can't find parking. What have you really done? That tweet was me sharing, right, an actual property where Chick-fil-A made us an offer. I know that broker well, really good guy. But we said, hey, I've got 50 tenants behind, you're going to destroy them. And he, off the record, agreed with me. So Chick-fil-A works as long as they're standalone. I have no problem with them. It's a great business. They've done a phenomenal job. They have great brokers, great real estate department. That tweet is just more sharing my experience and saying, heads up, there are other factors here rather than just what the value of your property, the impact of the value is. Karate studios, look, we obviously have them. It's a half joke, but look, we like tenants that invest in the space. It doesn't matter if it's karate or what have you. And a lot of times those folks put a mat down and the mirror up, and that makes me nervous as a landlord, right? I want them investing in a space, and leaving overnight, which happens in residential, doesn't happen to us, right? Like a burger place is not going to leave overnight. They'll sell the business or what have you. And so we like tenants that put capital in the space. I'm not going to generalize based on a sample size. Some tenants have more slow pay issues than others without me getting into it. And so that's come up. I had one tweet where I explained it, but it really has to do with investment in the space and, the odds of them just leaving one day, because we really don't go after mom and pop tenants. If someone breaks a lease, it makes no sense to go after them. They're giving up, and given that, we like to screen up front. So.
Yeah, I think it's really, I was going to make a joke that maybe you were just a little bit nervous when you had to collect back rent from a karate tenant, because your odds of winning that might not be in your favor. But, I think we've seen coming out of COVID, something that I'd like for you to maybe expound upon. A lot of these large national credit tenants that everyone was chasing after and clamoring after, leading into the retail apocalypse that never happened, has maybe changed their tune to these mom and pops now that we saw through COVID, where that's their life savings and their entire livelihood is tied to that one local shop that they run out of a strip center. Just walk us through that. You commented on that a little bit in that last answer, but it seems to me that even though they maybe don't have the credit worthiness, they're going to do everything in their power to actually make that business successful, because that's how they live, versus some of these other national folks that as soon as they see an opportunity, they're sending demand letters across their portfolio saying they want a 40% reduction in rent. And then you, as the strip center owner, are faced with this really tough conundrum of having to either deal with them or go through a legal process or whatever with a tenant that's well capitalized and has the ability to actually maybe affect some change. So what are your thoughts on that?
Yeah, sure. So when I started, there were no national tenants that were letting me handle their leasing for them in '02 with no experience. So I learned the business working with mom and pop tenants and was blown away by how much value they can create, how much money they can make. And right, I watched this Indian market grow from, I helped them find, I think, their first location. I took a sign call, it didn't work for us. I basically represented them and found them a space, made $4,000. And then I think they have 15 locations now. And, I've watched that over and over again where someone with one or two locations puts their life into these businesses and they make it work no matter what. Right. So to me, like this whole thing about, oh, don't you want national tenants? Where's the credit? It confuses me objectively. Lenders ask that a lot. And I said, where's the credit? Like this woman makes $400,000 a year net. Her kid goes to college based on the income, right? If the sales go down, she hands out flyers in the neighborhood, right? That's her life. That's her identity. She's going to make it work. If you screen correctly up front, a mom and pop tenant beats a national all day long in my book. I love the nationals. We've done plenty of deals. Know those brokers well. I'll do a national tenant deal any day, no problem. But, right, a local tenant, if they're qualified, they know how to operate and have experience, they're going to make that work. Or if not, they'll sell the business, right? A national tenant, nothing wrong with them. They're great. I love them. Okay, preface with that. Don't edit that out. If a tenant has a location that, they didn't get it right, they have all the data in the world, whatever, right? A national tenant does not know if the store will do well or not. They don't know. Nobody really knows for sure. So if they open a store, it doesn't do well, they're going to close it and it'll be on a spreadsheet somewhere and they'll move things around and that's it. Business is business. I love local tenants. They'll do a deal quickly, easy to get a hold of someone. Love the nationals. If you need an estoppel signed or camp reconciliations, take a long time and getting someone on the phone sometimes is harder. So, and even on the exit cap rate, you don't get really take as much of a hit as folks think that you do. If it's leased and someone goes, investors buying your property and walks in and it's a packed nail salon, it looks beautiful. They have 5 locations. They're 4.5 stars on Yelp, which we love. You're excited. You're not saying, oh, where's the Starbucks, right? And so, I think that's such an underrated portion of this business. And, we like to create great atmospheres and environments that, normally nationals benefit from. We create them for mom and pop. So, our centers attract some of the area's best mom and pop tenants, and they rarely ever leave. We've had one eviction in my whole career, right? So as long as you screen it correctly on the front end, that mom and pop tenant is absolute gold. They're fun people. They're full of energy. Love being around them. And so, I'm a huge advocate.
So let me ask this, that success often breeds imitation. You've been incredibly successful. You've pointed out on Twitter to hundreds of thousands of people that you have been successful. Imitation usually means bringing in newbies and rookies. What are some rookie mistakes that people that have been in other parts of the commercial real estate market and say, wow, I'm missing out on a great segment. They race into strip mall acquisitions, but don't have your level of experience. What kind of mistakes are they making or risking by, kind of getting out of their lane and getting into this?
Yeah, I think co-tenancy is a major one, right? Like you cannot teach that to anybody. That takes experience, right? Like every lease we get, okay, it's a boba tea shop. Well, our Starbucks says that they have exclusive on tea and coffee. Well, is boba tea fall into that category? Maybe, maybe not. So someone signs a lease with boba. Guess what? Starbucks sends you a letter a year later, as they should. Hey, we have exclusive on tea, which includes boba tea and coffee. Right? Or, you sign a lease with a tattoo shop, right? Which is good use depending on the center, next to a, children's dentist without thinking about it, right? Or you lease to that really, really busy hair salon when you have 3-to-1 parking ratio, right? Destroy your center. So, I think that's one. The other one is the underwriting of the rents is very, very different in retail, right? In the same exact center, you can easily have tenants paying 2, 3, 4 times more than the other tenants in the center. 25,000 square foot elbow is going to be different than your, end cap 2,000 square foot with a patio. So like you've got to be able to underwrite every single space in that shopping center, which you don't see in office really, or in resi a lot of the time. So and getting the rents off by 40%, that means that your value's up by 40%. You're overpaying by 40%, right? And so I think those two things, dry cleaners, come up on almost every single deal we do. If you don't understand that, what PCE is and the implications of dry cleaners, you should not be anywhere near this sector. If somebody spills a shot glass size liquid called PCE 35 years ago in the drain, you could have a $5 million problem on your hand today. That stuff does not go away. It's nasty. It's cancer causing. I've tweeted about it. And so doing a phase 1 is really important. If you've had a drop off only location, okay, hey, been there 25 years, drop off only. Can you confirm that it's a drop off only? You have an environmental lawyer that will, help you out with that. There's a property last year where our consultant said, hey, it's no problem. Let's test it here and here. Our lawyer said, you know what? This carpet cleaning tenant's been there for 30 years. And if I'm them, I might use some PCE and maybe dump it out the back door over here. So why don't you add a boring over here? Guess what? We added the boring. It was it'll be a $2-3 million issue for the owner. So, unfortunately, hate to see it happen. So dry cleaners are a complete landmine. Obviously, older centers that have value component have, a lot of them have had dry cleaners at some point in the last 50 years. Even if they've been gone for 30 years, it doesn't matter. Those 3 things really. And, I know a lot of folks are coming into the business right now and I welcome it. The account's encouraging it, but there are some landmines out there for sure.
We're really enjoying this podcast and the answers. It's great because this is an asset class that Manis and I and Haley can attest to. Like, we don't cover as in depth as some of the others for obvious reasons, but it's really great to hear from somebody that's boots on the ground, 20 plus years in the space, and some of the nuance. I know that you've also posted on your feed that a lot of times you don't even send an LOI, like you'll just send a signed contract over when you're trying to negotiate. So give us a little background on that. And has that led to more deals? Is that something that you guys try to do as a business rule, or is it just used in certain instances?
Look, like in some states, like in California, for instance, there's a CAR form that folks use when they buy a house. They're comfortable with it, right? The one that's used for commercial properties looks the same. And it seems like, which it should be a neutral contract. So we just send that over versus our competitors might send an LOI, wait for a response. I'm like, okay, I want this deal right now for $3 million. Here you go, 35-day close. Here's the CAR form that you already know because you bought it when you used your house. Those come back signed all the time. Even when lawyers get involved, they might add a short addendum. It doesn't really tweak much. We've had success in certain markets doing that, right? Sometimes you can't do it. There's a deal we did with a large institution last year where I didn't realize who the seller was the first day, and we sent that CAR form, and it was a little bit odd. We ended up backtracking, sending a LOI, and it worked out. They sent us an 84-page contract, so it was good. It worked out. Got the deal closed on it, right? And so anything to remove friction from getting that deal, we will do. And a lot of times LOI, which I think like folks get trained on LOIs, and today it could just be an email. Send an email. Here are my 4 deal points. It's non-binding anyway. What do you think? Right. So it's become this long process in leasing and in sales is LOIs. I mean, I avoid them, and if someone sends me an LOI, I pause. I'm like, hey, shoot me an email with like the 5 deal points and let's just go from there.
Yeah, I think that makes sense. On that point of just sending the contract over and then finance and doing an all cash transaction and financing on the back end, how has that shifted, if at all? Obviously, you're still buying all cash, but your proceeds upon refinance have probably been changed with the cost of capital and the higher interest rate environment, bringing some values down, or at least the lender's perception of value is less at this point. Has that modified how you've approached any of your current deals?
No, I mean, we've always been 55% LTV maximum. It's actually in our fund document. I'm not big on a lot of leverage after going, after 08, when folks much smarter than me handing me keys and saying, don't see, which we didn't. But I can't forget those moments. So we are low leverage. So in this market, it's easier to get loans and folks that, are maybe at 70%. Yeah, I mean, we're getting quoted 7.25% on deals that were maybe 4.5%, 5% a year and a half ago, 2 years ago. That goes into our model, right? The IRRs still have to be there. So, some deals might not work because of that, but ultimately it hasn't killed any deals yet. And we're getting selected because we're all cash right now. A lot of folks are retrading. They get really excited. They see a 6 cap in a 4 cap market, and they're like, oh my goodness, full price offer. Call their lender's like, oh, 7.5, 7.25, and then they back out. So I think brokers have seen that play out enough now where they love our all cash approach. And look, it's a very important marketing tool when brokers know that you're all cash. They love that. I was a broker. I used to love those buyers. Sellers love it. We don't order appraisals during escrow. There's no third parties, loan committee, investment committee. It's me, right? Like RLPs give me full control as far as what we buy, right? Based on a track record since 2006. And so we move quickly and are not at the mercy of, lenders, et cetera.
So you brought up the specter of the great financial crisis, getting keys sent back to you. Tell me first what your stress was like during the early days of COVID, which was kind of the most recent black swan event. And then after that, a follow-up would be, what would something be that keeps you up at night now? What is a black swan event that could be in your back of your mind right now? You said, well, if this happens, I would really tap the brakes if we started seeing this kind of data or this type of economic switch or something like that. Is there something out there that keeps you up at night?
Yeah, inflation. If we start heading back to that 7, 8, 9% reading level, that's going to be a major problem, I think, for everyone. I will say the current fund's about a third deployed. So if that happens in a way, I don't want to see it happen, but if it does, we have capital to go buy some really great deals. So, I think number one is inflation. And I think that's a much greater risk than the Fed keeping rates at these levels. 2008 was scary because you didn't know what the bottom was, right? Like there's people offering you homes for $100,000 that were going for $500,000 and you thought they were going to zero. I mean, it was such a scary time that like layoffs were massive. I remember Obama on the news every week saying, hey, lenders, start lending. I mean, there was so much fear in the market. We're not seeing that much fear today. I mean, there is some in the office sector, but overall, as long as folks have jobs, there usually isn't a lot of fear. And that's in 2008, some of your friends started losing their jobs, and that was a scary thing. Phones stopped ringing. And so I think back then it was job loss, and here it's that threat of that, inflation. If it ticks up again, that's going to cause a lot of problems to, for a lot of people in all sectors, and it's not going to be fun. So I know some folks are rooting for that, but trust me, you don't want to see it.
Yeah, it's interesting. We've got a lot of people, preaching the distress gospel right now, and for valid reasons. Like we've been on a 10 or 12-year bull run, but I would suggest there's a lot of people who never actually lived through a distressed market and what that actually means. And the headlines are going to talk about the ones that actually go through the full foreclosure process or get tossed back. But even the ones that are able to hold on to their properties, it causes a lot of mental anguish and a lot of collateral damage that maybe doesn't get talked about enough. And so I think it's an interesting part of the cycle that we're in right now. And I think for folks like you all that are well capitalized and set up in a fund structure, it gives you a lot of flexibility. We had a gentleman on from Acor Capital not too long ago on a guest pod, and he was talking about being backed by life cos, and they had the opportunity to look at this downturn as very opportunistic for them to fill gaps in the capital stack and do things that maybe traditional lenders weren't able to do. And so it's just the perspective of where you sit and where you're at. A lot of times it's determined by your availability of capital, how you can use funds. I know we have a couple of questions from our listeners and others on social media. I wanted to throw one of them out real quick. We had one of our listeners ask about converting mom and pop tenants over to a triple net lease structure. And so I think this is one we'd like to get answered on the pod. What is your strategy when you go into a center that maybe is on a gross lease type of structure? You're talking through this new triple net, or you're trying to get them to a triple net. They may not understand it. They may get confused. Is that an impediment for you? Is that an opportunity for you? Like, how do you guys approach
Sure.
that, and how are you successful at that?
Yeah, it's funny because I'll read on Twitter, like folks say, oh, buy a retail building and just turn the gross leases into triple net, which it's nonsensical, right? So, a tenant looks at it as, what am I paying per month? If it's $3,000, I don't care if you call it gross, net, modified, it doesn't matter. So like if I go in, right, and they're paying $3,000 and that's equivalent to $24 plus net, which is the market net in that market, they're paying market. There's no raising the rent. So go ahead and convert it, but it's really semantics at that point. I mean, you're just changing the language of the lease. Sure, if you sell later on and taxes go up, you're protected. There are advantages, obviously, but it isn't some way to like create a bunch of value and raise rents, because ultimately a tenant can only pay what they can pay.
Yeah, I think, and that's something that's being tested right now, right? If you're on a triple net structure, like we've seen, and the data that we track shows, insurance costs are going up, pretty much without regard to property type. Property taxes are always something that gets reassessed and goes up. And so, you have this occupancy cost for some of these tenants that's become outrageous for them. And even though they have a low base rate, the pass-throughs come back to them, and it makes it where they can't afford to stay in the center. And to your point, there's no magical value creation, but I do think there's a perception, at least in the market, for some of the more sophisticated buyers that they want to at least see a triple net lease structure in place, whether it's valid or not from a value perspective, right?
When you're selling the property, right, obviously it's cleaner. Banks like to see that, get more money. But, as far as the nets going up we've seen it in California, right? I started in 2002 in this business, and like in that market, the rents have not gone up that much in all these years in retail, because as sales have happened, those taxes have caused triple nets in that market to be $12 all over the place, where maybe they were $3 when I started. So I think that you're starting to kind of see that everywhere else now a little bit with insurance, et cetera. But that's why for us, we're not buying based on, rent's going to grow in this area or what have you. It's about intrinsics day one. But, I think as far as anyone buying, thinking that rents will go up in the next 5-10 years, do not buy banking on that. You'll probably be disappointed.
I feel like because you're behind a persona, I need to throw out one or two questions that kind of pull back the veil a little bit. So let me ask you this first. If you weren't in commercial real estate, what would StripMallGuy be doing?
Probably teaching. I love teaching, helping, educating. When the students have a passion for whatever the subject matter is, maybe it's something that I'll do one day. And during college, right, like everyone else in 99, 2000, I had a small tech company. It didn't work out. And so tech's been definitely something that I've followed. It's a passion of mine. A lot of our LPs come from that world. I'm sure I would have had a startup or two by now.
And you've been in New York for not too long, but you came to the Big Apple. What's your favorite thing about being in the Big Apple? What's your favorite part of New York?
The energy. Oh man, I mean, it feels like there's a personal trainer yelling at you 24 hours a day, which is good and bad. But wake up in the morning, leave our building. I walk down 40 minutes to the office in Midtown every single day. Just feel the energy, and it just pumps you up. It really does. It's wild.
Yeah, I think that's for me especially. I'm a hybrid. I spend a lot of time in New York and a lot of time in Texas, and the difference between the two lifestyles is I should write a book about it someday. It's really interesting. I love the New York energy as well, and I think when I fly in, especially if it's in the evening time and the skyline is all lit up and the buildings are there, like there's no way you can't even just fly into New York and not get psyched about it. Like it's got its own aura that's unlike anything else that I've experienced. So one last question for me on a lighter note. I was hoping that you were going to say, when Manis asked that last question, that you might be an HOA president if you weren't in commercial real estate. So maybe give our listeners a little bit of your flavor for HOAs.
Yeah, it's funny. So I started tweeting about HOA like right when I started on the platform, and those really resonated. And someone's like, "Well, why don't you be HOA guy?" And so the backstory is I bought my first condo when I was 34 years old, because I kept putting all my money in strip malls. And so I said, you know what, I'll buy this property, good view, whatever it is. And so great location, older building. And I said, okay, well, here's a no-brainer. We'll go in and everyone will chip in $5,000 for a new lobby, and our values will go up by $100,000 each. And then we'll do a little roof deck, and it was so obvious, right? So I walked in, I was 34 years old, and I knew nothing about HOA, how it worked. I said, oh, they'll love this. I'm the real estate expert, right? So I walk in there, and There was a woman that screamed so loudly that she fell out of her chair. She literally fell out of her chair when I suggested that we install radiant heat, which is an old technology, right? She acted as if I invented radiant heat and said I would flood the building. And then someone sent all the residents a letter and dropped it off on everyone's door, how this new real estate guy who is a flipper is now joining our community and wants to change the way that we live our lives. And I thought it was like a hidden camera. It was the craziest thing I'd ever heard in my life. And so I fought for the radiant heat because it made no sense otherwise. I got that. But after a year and a half of meetings where I was humbled every single time, yelled at, one guy was a ski helicopter instructor who would scream at my ideas. You don't know what you're talking. You're crazy. And I was like, why don't we just pay an extra $9 a month for X and Y and Z? And it's like I was defeated. They won. I sold the condo a lower price than it was worth just to get out. And so so I'm not, I guess, a good team player in the HOA setting, I guess I would say.
Well, StripMallGuy, I have to say thank you for joining us today. This was an awesome episode. It was great to kind of dig into one asset class specifically, hear your background, and learn about how you became who you are. So if you're not following StripMallGuy, his handle is @RealEstateTrent on Twitter. And tell him you came from the Trepwire podcast. We'd love to see that. So thank you again. We're looking forward to releasing this and getting feedback from our audience.
Thank you guys. Enjoyed it a lot. Have a good rest of your day and we'll talk soon.
And with that, we'll close this special podcast. Thank you to our guest, StripMallGuy, for joining us today. Join us later this week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send an email to podcast@trepp.com. Until then, visit trepp.com for more info and subscribe to the Trepwire podcast with your favorite provider. Thank you for listening and stay well.
All right.